Yeah. Good evening, everyone. Welcome to the Market Insight webinar, second edition for the calendar year 2024. Myself, Niranjan, I am part of a product team at UTI AMC and your host today. I am also joined by our Chief Investment Officer, Mr. Vetri Subramaniam. Welcome you, sir. And Fund Manager, Mr. Karthik Lakshmanan, who is currently overseeing our flagship funds such as UTI Large Cap Fund, erstwhile UTI Master Share Unit Scheme, and also UTI MNC Fund, which is a thematic fund. So once Vetri and Karthik's initial remarks conclude, we will open up for Q&A. So keep sending in your questions, which we will be able to take up subsequently. So without further ado, I now request our CIO, Vetri, to take this forward. Thank you.
Good evening, everybody. Thank you for joining us here on this edition of the Equity Market Insight. And Niranjan, as usual, has put together a deck that we'll be using. So I'll just wait for Niranjan to get that deck up on the screen. This time, we've also got the budget, which just happened recently. So I also thought it was a good opportunity to, sort of talk a little bit about, what's happening in the budget. And the kind of numbers that you see there. So we've got some of the numbers up on the screen over there, and you can see these. And I think the big message from this budget, if I can call it that, is actually that of fiscal consolidation. If you look at the left side chart, the darker portion of the bar is the fiscal deficit of the union government, the central government in Delhi. But it's very important to remember that the total fiscal deficit of India is union plus states, because the states also run a fiscal deficit, and therefore we need to look at that combined number. Now you can see there the biggest bar, which is actually the fiscal deficit in the year of the pandemic, which is 2021. The consolidated deficit was well above 12%, closer to 13%, and the central government itself was about 9%. I think the big story in this budget is that against the expectations of 5.2, 5.3% deficit, the central government is targeting 5.1, and including the states. This is obviously again only an estimate because the states are still presenting, but the states typically don't go above 3%. So we can look at the consolidated fiscal deficit of India coming down to about 8% from its peak of almost 13%. This will still be above the level that we saw immediately in the pre-pandemic period, because the union government is higher, states are marginally higher. But when you look at the aggregate numbers on the right side, I think this is very good news, which is that the absolute deficit has actually now remained unchanged for almost 4 years. And based on the trajectory that we are talking about for the union government, with a target of 4.5% in 2026, the actual deficit will remain unchanged for almost about 5 years by the time we get to 2026. So I think this is a positive development. It's very difficult to reduce the deficit in absolute terms, but if you can hold it consistent on a percentage of GDP growth, it will actually start to decline. And that's one of the advantages of having GDP growing. And in fact, we have one of the fastest growing major GDPs at this point of time. So the denominator, which is GDP, is growing at 7% in real terms. In nominal terms, maybe closer to 11 to 12% on average. And that will ensure that the fiscal deficit as a percentage of GDP, hopefully we can pull it back to where we were in 2018. On the next slide, we're going to talk about a longer term trajectory of how tax collections in India have consistently been going up over a period of time. On the left-hand side, you can see personal income taxes as a percentage of GDP. There is a huge acceleration which takes place somewhere between 99 all the way till about 2009, 2010. Then it sort of stays muted for a while. And then again, from about 2016, you are seeing a very significant acceleration. Actually, the acceleration is more visible after 20, but I would say the initial setting for that was maybe set up already by around 2016 pre-demon, and then we have seen the hockey stick kick in the last 3 years. And personal tax collections, this is the tax paid by individuals, is now almost 3.5% of GDP. On the right side, you can see GST collections. This is a more short-term chart. Obviously, GST came down during the pandemic period, but now it's recovered to almost about 6.7, 6.8% of GDP. So, this is again a number which is now quite consistent, and therefore on a consolidated basis, when you look at the data, we are looking at a significant tax to GDP ratio. This is a structural improvement that we have seen, and the benefits of this should flow in over a long period of time. If you just move to the next slide. Now, what is the impact of these strong tax collections, and secondly, the impact of the government keeping the fiscal deficit under control? Now, when the government has a fiscal deficit, it has no option but to borrow money from the market. Now, what you can see over here in these two slides is the gross borrowing that the government is doing. Because remember, when the government has to borrow so much money from the market, it is taking away money which could be available to you and me. It is taking away money which could be available to the private sector or the corporate sector in general, which might want to borrow money to invest. So they are what we call in economic terms crowding out private investment by borrowing so much. But what we are seeing now is that the gross borrowing is consistently coming down. Here again, actually, in absolute terms, it is more or less the same. But as a percentage of GDP, it is now declining. It is almost coming back to where we were pre-pandemic. Slightly higher on a gross basis. On a net basis, it's still slightly higher than where we were pre-pandemic. But remember, FY26, we will get to 4.5% of GDP. So, this number will continuously come to trend down. Now, that's one of the reasons that the visible impact of the pronouncements made in the budget to remain on the path of fiscal discipline, to bring the fiscal deficit down to 4.5%, the market which captured this the best was actually the bond market. So if you look at the 10-year yield from trading in the 7.20, 7.30 range, it's actually dropped to 7%, 7.05. It's now been trading in that range post the budget announcement. So this sort of intention, this commitment to fiscal discipline is showing up in the fact that now the borrowing number of government is much lower, more money available to everybody else, and therefore the 10-year government yield has come down. We can also see what the impact of this will be on the next slide. Now, on the next slide, on the left-hand side, this is one of the topics that we discuss a lot. What's the trajectory of capex by the central government? Now, on the left-hand side, you can see two charts. One is revenue expenditure as a percentage of GDP, and you can also see the red line, which is the capital expenditure done by the government as well as by the public sector companies, because the number that they report in the budget actually includes all these numbers. So when you put that together, what you can see is that there has been a good and consistent rise in the total capex which is being done by government and the PSUs, intra-budgetary resources that is called. And if you look at the revenue expenditure excluding interest payments, there was a big spike which happened in the pandemic year, but now we have come back to exactly the level that we were in 2019. So I would say this suggests that there has been a very strong commitment to fiscal deficit by the government. They have reduced what they think were wasteful expenditures, and this has allowed the revenue expenditure compression to be much sharper than what we are actually immediately able to see in the fiscal deficit, and full credit to the government for this. On the right side, you can see the split of capex that is proposed to be done this year. If you look at the headline number, from the previous budget number of 2024 to 25, the increase in capex is about 11%. But some of the expenses which are shown in this year's budget, if you see, there is this one item called new schemes, 7% of the total spending is going there. And also there is a large allocation by way of telecom, which actually reflects the capital injection that government is having to make into BSNL, which is the government-owned telecom company. Of course, there was an allocation last year as well, but this is not capital expenditure in the classic term. So on a headline basis, the growth is 11% budget to budget. From revised estimate of 24 to budget estimate of 25, the number looks like 16% because we spent less in 24 than we budgeted. But if you actually do a adjustment for telecom and for this new scheme, which the contours of which are unknown, then the increase would be more like about 7 to 8%. So there is some slowing of capex just on a trajectory basis, 30% for 2 years. Now we are coming down, but I would say the positive impact on the economy will be that the absolute number is still increasing, and that is certainly good news. So, this is about the message that I wanted to convey as regards the budget, fiscally disciplined, and to the extent possible, continuing the trend of capex and showing very strong control of revenue expenditure and subsidies. Moving on to economic trends. There has been some upward revision to growth estimates for 2024. The estimate now is closer to 6.8% for 2024. It's up from what we used to see earlier, but remember, the Bloomberg consensus from professional economists is still lower than what government and RBI are forecasting, which is about 7%. We'll have to see which number catches up where. But even in the 6.5-7% range, India's growth would still be very, very creditable for this year. We'll move on to the next few slides. This is the high frequency indicators. I won't spend time on this, Niranjan. We can just move on. We look at the equity markets and valuation. The big story in terms of performance, of course, in recent times has continued to be the Nifty small cap. On a 3-month basis, it's doing 13% better than what the Nifty 50 is doing. On a 1-year basis, it is doing 45% better than what the Nifty 50 is doing. So remarkable outperformance by the small and mid cap segments compared to what the Nifty 50 has done. This is where India's performance fits in a global context. In a global context, we have done quite well. If you look at the 1-year basis, of course, Japan had a spectacular year last year, but some of the other EMs as well had a good year. Brazil up 12%, in US dollar terms, maybe slightly better. US S&P 500, of course, was up only 11%, but remember the NASDAQ, which is a $1 trillion market, almost $20 trillion market, that was up almost about 45% last year. So phenomenal move by such a large set of companies. But in general, the story of the last 1 year has been the massive underperformance by Hong Kong and China. That's really been the worst performing segment of the market. And even the beginning of 2024 has started the same way. You can see China and Hong Kong at the bottom on a 1-month basis. So we'll quickly move on to the next few slides. The current estimate, if you look at the right-hand side, 15% earnings growth for March 24. Now, 9 months are already over, so we already have the data for 3 quarters. I don't think there's too much risk now to the 4th quarter estimate. So, 14 to 15% growth is what the consensus is currently estimating. And for 2025, the estimate is again for about 14% growth in earnings. Remember, between 2020 and 2023, there was almost a 70% jump in the Nifty EPS. So we are slowing down relative to that massive 3-year jump, but 14-15% is nothing to sneeze at. It's still a very healthy number. Next slide just shows you the trend in terms of EPS forecast. Again, nothing much over here. Slight cuts have happened to the both 24 and 25 EPS estimates in February, but I would not say it is particularly remarkable. Move on to the valuation slides. You all are familiar with this. The left-hand side, Nifty trailing PE, it's somewhere between the yellow line, which is the long-term average, and the red line, which is the expensive zone. So, it's rich, but not completely expensive. On a forward basis, the market is now quite expensive. It's above that red line. On the next slide, you will see the price to book. The price to book, once again, is in reasonably comfortable zone. It's above the yellow line, well below the red line, and not in the expensive zone. So we'll talk about this later, but based on this, one would certainly argue that large caps in India are slightly above long-term average, but they are not uncomfortable in terms of valuation. They are sort of, I would say, more in the fairly valued neutral zone. And on the next slide, we have the mid cap and the small cap. This is an area of concern because here benchmark valuations are at record levels, both on the mid cap and small cap, and which is why our preference, I'll sum it up later, is more towards the large caps than towards mid caps and small caps, primarily based on valuation. This is how we look relative to the bonds. So the current yield differential is 2.17%. One reason for this is, remember, the bonds actually rallied by about almost 20 basis points over the last 1 week after the budget, and that's resulting in that line going up. But on a historical context, this is a tactical indicator still saying that fixed income looks more attractive than equities does. And this is one of the indicators that feeds into the dynamic asset allocation model that we run at UTI Asset Management, which drives both our multi-asset fund as well as our balanced advantage fund. So just jumping through, we'll just go to the next slide. So just to quickly sum it up, I think one of the big challenges that we have today when we look at the US is that their data is still very robust. Economy is growing very well. The market expects 140 basis points of rate cut, but that's a very high bar. In fact, even on Monday, the US Fed chairman was talking about perhaps 3 rate cuts and not more than that. And I think they are clearly trying to talk down the market. The outlook for rates in the US remains that it doesn't go back to what we saw during the last 12, 13 years, simply because inflation is likely to be higher because of higher fiscal deficits. And secondly, you are also trying to simultaneously reduce the Fed balance sheet by selling bonds. In India, inflation number is within the target range, but the RBI governor wants to now get to a target of 4% inflation, and therefore we think any rate cuts in India are likely to be back-ended in late 2024. Nifty earnings growth we've already talked about. There is a dichotomy in valuations between large cap, mid cap, small cap. So our preference in terms of allocating money would be toward large cap stocks. So in a UTI context, schemes like our focused fund or the large cap fund, which Karthik will talk about later. These are the funds where we think, the valuations give slightly more comfort as compared to mid cap and small cap. In general, we think this is a good time for investors to adopt a staggered approach towards equities. If you want to invest lump sum, then strategies like the balanced advantage and multi-asset fund are good options. Their equity allocations are currently running at about 50%, which is in the middle of their range in which they can move their equity allocation. So for lump sum investments, you could consider that. More conservative investors can consider the equity savings fund, where the equity allocation tends to be closer to 30%, though it has gross equity positions of 65%, and therefore it gets classified as an equity scheme. So that's about it as a wrap from my side in terms of what's happening in the market, where we see valuations. So delighted to now bring Karthik into the conversation. Today's context, one of the strategies he'll be talking about is the large cap fund, which is where we think there is some, reasonable investment opportunities in the market today. Over to you, Karthik.
Thanks, Vetri. Good evening, everyone. So I'll be talking about the large cap fund, UTI large cap fund, which was earlier called as UTI Master Share. So this is a fund with close to 37 years history. And we've had the same strategy for last many years, predominantly large cap, at least 80 to 85% in large cap companies. That's the top 100 companies by market capitalization. And we do have some exposure to mid and small companies, about 10 to 15% odd. Typically, we tend to have about 50 odd companies, 45 to 55 odd companies in this fund. And the strategy that we follow is one of competitive advantage and growth at reasonable price, which we'll discuss a little in detail in the subsequent slides. The benchmark is BSE 100. Now, if we look at the advantage of large caps, clearly the large companies, many of the large companies would have gone through many cycles. And to that extent, their balance sheets are tested, and their balance sheets and the managements have weathered through many cycles, and they are in a better position to handle economic volatility. And to that extent, they are better off. And needless to say, many of these companies, just because of their sheer size, have economies of scale. They have cost advantages or efficiency, better efficiency than many of their smaller peers. Besides, many of them are leaders in their category and they have some competitive advantage. If we go to the next slide, if we see in the last 15 years or 13 years, FY10 to FY23, we've taken 6 sectors or subsectors as example, where we can clearly see the top few companies have either retained share or gained share. For example, in the case of banks, nearly 60+% of the incremental share has come to the top 6 banks on the credit side. Similarly, if we take cement again, there has been clear consolidation, and the top 5 companies have contributed for nearly 58 or 60% of the volumes. Similar picture for passenger vehicles, domestic pharma, paints, telecom, and so on. Just to show that it's been even though the economy is growing at a fast clip, the large companies have still continued to gain share or retain share. So to that extent, they have still done reasonably well compared to many of their mid and smaller peers. Going to the next slide, in terms of performance, if we see in the last couple of years, as Vetri also highlighted in the market performance, what we've seen is the mid and small caps have outperformed the large caps significantly. In this chart, what we see is the returns difference between Sensex and mid cap, which is the blue line, and the Sensex and small cap, which is the red line. If we see, it is at the extremes as far as the 1 year returns difference is concerned. I mean, we've seen such extremes probably 3 or 4 times in the last 17 years. We are almost close to that extreme. And if we go to the next slide, again, on a 5-year rolling returns also, the yellow line is the mid cap, and the purple line is the large cap on the left-hand side chart. There also, again, the gap has kind of increased to a significant level. The same situation on the right-hand side, where the comparison between a large cap and small cap. The point being that even on a 5-year rolling returns, the gap is very stark. And typically, when we have such stark gap between the large cap and mid cap or small cap, the subsequent years, the performance kind of reverses. So the previous slide, we saw 1 year returns, and now we saw the 5-year returns. In both cases, what we are seeing is the mid and small caps have significantly outperformed. And to that extent, from a risk reward perspective, the future few years, probably the large cap stacks well as we speak. And obviously, the volatility in large caps is clearly lower, as seen in the standard deviation. The large cap or the Nifty 100 TRI is 4.6, while the same number for mid cap is 6.55 and small cap is almost 8%. So it comes with lower volatility, and from a current position, clearly they seem a little more attractive, which we saw from a fundamental perspective in terms of the PE chart as well. If we go to the next slide, from an exposure perspective, if we see, retail investors have been very active in the last 3-4 years during the COVID phase, and their exposure to mid and small caps have actually inched up during this period. So if we see the large cap, which is marked on the left-hand on the right-hand side, has come down from 70+% exposure of the retail investors allocation to sub 65, while the mid and small caps have actually gone up, which is marked on the right-hand side, on the left-hand side, to about 15% and close to 20%. So clearly, from a retail investor perspective, the exposure to mid and small caps is already higher. And same way on the right-hand side, if we see the institutional investors, whether it is FIIs or domestic mutual funds, the exposure to large caps have come down in the last 3-4 years. So on positioning as well, whether it is retail investors or institutional investors, already the ownership in mid and small caps have gone up, and they are little underweight on large caps. So to that extent, also the room to further add on mid and small caps may be limited, or the trend may reverse. In both cases, the large cap would actually benefit. Going to the subsequent slide, coming to UTI large cap strategy. Like I mentioned, this is a strategy where we focus on competitive franchises within the top 100 companies or the large caps, we try to identify companies with some competitive advantage or moat, which could be in the form of low cost producer, or in the form of distribution, or in terms of the brand or network effect, and so on. So this competitive advantage helps in the earnings growth, visibility, and sustainability. So higher the competitive advantage or the moat, higher the strength for the company, and longer the visibility for earnings growth. And again, we follow growth at reasonable price, wherein we try to evaluate the growth potential, long-term growth potential of the company, and compare it with the current valuations. So if the current valuations do justify the growth potential of the company, we do look at those companies which have been already filtered for competitive advantage. Going to the subsequent slide. These are some of the examples of competitive franchise which we've discussed in the past as well. Just to repeat, this is one of the large private banks where clearly the low cost deposits itself has acted as a very good cost advantage for the bank. And that has helped the bank to grow at a rate north of 30% in the last 23 years. And its underwriting discipline has only helped it in growing it profitably, which is reflected in the stock price returns as well. Subsequently, if we go to the next slide, I'll skip this again, another financial. If we go to the next slide, there is a passenger vehicle company. Again, this company is more than double the market share of the second player, and has had significant cash flow creation in the last few years. And that has helped the stock price as well. And here the share market share itself has helped it in the economies of scale, and helped it to have significantly higher profitability than the rest of the pack. Again, a large value retailer has focused on throughput, and through the throughput, it has kind of been an efficient player, and improved the profitability in a very cutthroat competition business like value retailing, and still has been able to grow faster than the industry and gain market share profitably. So these are some of the examples of competitive advantage. Like I said, this provides us that comfort and the visibility of earnings growth from a longer term perspective, which helps especially in tumultuous or volatile times as far as the economy or the market is concerned. If we go to the subsequent slide, and more examples on paints, telecom, and so on. Like I said, this is one table we wanted to highlight. If we take the last 20 years, we've had at least 7 instances where the BSE 100 is corrected more than 20%. And in each of the 7 instances, UTI Large Cap Fund has been able to outperform the BSE 100 on the way down. So on the way down, the quality of the portfolio companies kind of comes to the fore, and being competitive franchises, they've been able to hold on better in the stock market, and that's helped the fund outperform. And if we see the last 2 columns, the subsequent 3 years and 5 years, the returns in the fund have been quite good. Just to reiterate the point that when the markets go down, probably that's the time to kind of hold on, or if possible, kind of add on, because the subsequent years' returns have been far more favorable. Coming to the next slide. These are the top 20 holdings in large cap fund as of last month. If you see on the left-hand side, the top 20 companies roughly comprise of almost 70%, just to show that the top 20 companies is where majority of our exposure is, where we have conviction, we have very good weights. Within that, if you see the active weight, that is the weight higher, the weight difference versus the benchmark, which is BSE 100, we'll see that most of them have positive numbers, which means wherever we have conviction, we've had a good overweight, hardly 1 or 2 names where we have a underweight kind of a stance. So on the top side, we show the high conviction portfolio, the top 20 companies, almost comprising of 70% odd. And if we look at the right-hand side, we have almost 10 to 15 odd stocks in the mid and small caps, which are obviously not part of the BSE 100 benchmark. They are the unique stocks from a large cap fund perspective. They're right now around 9 odd %. Like I said, over a longer period of time, they tend to be in the range of 10 to 15 odd %. Here we have companies which we believe will grow faster than many of the other peers set. And some of them could eventually become large caps as well, or in some cases, they could be the market leaders. So these are the companies that we buy, and many of them, the holding period have been very long. We've been holding them for 5, 10, and 15 years. So even within the mid and small caps, the strategy is to kind of buy and hold structurally high growth or good quality businesses. Going to the next chart. This is the overweight or underweight position from a sectoral perspective for UTI large cap. We are overweight on IT, auto, and consumer durables, pharma to some extent. We are underweight on FMCG. We are underweight on metals, power, construction, and oil and gas. So these are overweight, underweight positions. And on the right-hand side, you see the top 5 overweight names, which is some of the IT companies, consumer services name, financial services name, telecom, and so on. Underweight, like I mentioned, some names in FMCG, oil and gas, construction, and so on. Going to the next slide, this is just the 37-year history. I mean, if this is a theoretical exercise that if 10 lakhs was reinvested, I mean, all the dividends were reinvested through this period, and the investor stayed invested for the entire 37 years odd, how the returns would look compared to the benchmark, just to show the power of compounding from a longer term perspective. With that, I'll stop and then I'm happy to take questions. Niranjan, back to you.
Yeah, sure. Thanks, Karthik, for that detailed overview on the fund, UTI large cap fund. So, participants, now we will take the questions which are coming our way. So, kindly keep posting your questions, and we will take them to Karthik or Vetri in the next 20-25 minutes. So here is the first question, Karthik, to you. The last year, 2023, had been a very great year for mid and small caps, given that they surprised the entire market with great performance, right? So how we actually look at these pockets? Do you think they can actually continue to outperform, and also what are the pockets that you remain bullish when it comes to the UTI large cap fund, given that the portfolio allocates between 10 to 15% in these pockets?
Right. Niranjan, like we discussed clearly at this point in time, as a category, probably in the mid and small caps after the run-up and the valuation being in expensive zone, as a category, they look expensive. But not all companies are in the same bucket. There are companies which have grown very well, or where the valuations have still not moved up. So to that extent, we still have some pockets where the risk reward is favorable, and that's where even in UTI large cap, we do have some exposure to mid and small caps. From a pockets perspective, even if we go to the slide on the unique holdings, we'll see that we still have some names in auto ancillary, some names in consumer durables, where we believe the long-term growth story is still intact and the valuations have still not been very expensive. So we still believe that there are pockets of opportunities. From a longer term perspective as well, clearly there are a handful of companies in mid and small category which have done exceedingly well. But only when we look at the entire category, probably after a sharp run up, there could be some amount of kind of correction or underperformance in the subsequent years.
Yeah, thanks, Karthik, for that. Vetri, there is a question to you. This is a great news from India's point of view, given that Indian stock market has overtaken the Hong Kong's rank in terms of the market cap, and India has emerged as the 4th biggest equity market globally for the first time, right? And the current capitalization is also over or around 4.5 trillion. So while this is the result of confluence of several dynamic factors, what are the key risks you think actually the Indian market is exposed to today? You're on mute.
Vetri, you're on mute.
Sorry. So obviously, it's a good thing that the economy is growing in size and scale. We become more relevant to the global system as our economy grows in size and scale. The same applies even to the stock market. The bigger you become, people have to take a view on you. You cannot be ignored because you become a very big component of the marketplace. I think the story of India's sort of rise now reasonably well known. In fact, I was just looking at some data. If you go back even to December of 2020, India's weight in the MSCI EM used to be 9%, and China's weight was 39%. Today, India's weight is at 18% and China's weight is at 25%. So, you can see how the relative movement has happened over the last 3 years as Indian equities have done well and, Chinese equities not so well. Now, very quickly in terms of risk, Niranjan, I would say there are, two economic risks which are at opposite ends of the spectrum. One is that the market, as I talked about earlier, is now starting to factor in significant rate cuts in the US, right? Now, the fact of the matter is that the labor market remains extremely tight in the US. It's record low unemployment. GDP growth still running at the 2.5% to 3%, sort of trajectory, and wage growth for the last year was almost 4.2% year on year. So, while we can take some comfort in the decline of inflation, and the Federal Reserve is trying to say don't expect big rate cuts, what if inflation actually turns up? Because I think markets have already discounted a turn down in inflation. I think the risk is really that you don't see a further decline in inflation. Worse still, if you see an upturn in inflation, maybe because of supply side issues, maybe whatever issues, but that is something that the market is not prepared for. At the opposite end of the spectrum, because remember, risk is at two extremes. Two completely different things can happen. The risk at the other end of the spectrum is essentially that we started 2023 saying US recession, it never happened. What if finally the recession does happen? Again, markets are no longer prepared for a situation where the US experiences a recession. Markets are also vulnerable, as are economies, because then you would have the US in a recession and China, which is the world's second largest economy, reported to be growing at 4 to 5%, but many people would argue that those numbers are incorrect. So when you have two large engines of the world economy struggling, it is not good news for global markets. It is not good news for risk assets. So I would say these are two extreme outcomes, very different scenarios where they would play out, but they exist. The other risk, which is again related to that recession, is fragility in the US financial system. Even yesterday, we have seen one more smaller regional bank getting downgraded to junk because of its exposure to commercial real estate. So, the longer the US rates stay high, there is some risk of financial fragility impacting us. I think if you were to sort of focus more locally into India, there are two risks that I would point to. The economy is doing well at 7%, but not everybody may be growing at 7%. That is always the case. But I think when you look at the percentage of the economy, which perhaps the rural side of the economy, we have had many companies, even today, one of the FMCG companies was talking about the stress over there. And we can see this in many metrics. It does raise some concerns about how well balanced this economy is. It can get addressed. It will just require time to get addressed. The economy continues to grow at 7%. Gradually, we see construction pick up, real estate pick up. It will create jobs where farm sector people may be able to shift into these jobs, and it will pick up steam. So it is not a serious issue, but it might just sort of take time to get addressed, and that's something we'll have to look at. I think the other sort of significant issue from an Indian context is really the burden of expectations. I would completely be excited about the prospects for the future of India over the next few years. The challenge is that potential is in many cases now getting reflected in the valuations. So now your outcomes are more likely to be driven by implementation than by potential. And that, to my mind, is where the risk lies. If there's anything which goes wrong in terms of implementation at a stock level, at a sector level, because something happens in the global economy, because regulations change, then a section or large parts of the market could become vulnerable. So that's really the risk that we carry right now.
Thanks, Vetri. Rightly put, implementation is everything. So there is one question, Karthik, on the portfolio level again. Back to you. So how do you actually decide on the position sizing when you actually build on an exposure into a particular stock? So what are the things that you look at? So if you can elaborate on that, and also what is the current portfolio stance, or in terms of like the recent portfolio changes that you have made, if you can just throw some light on that.
Yeah. Then first on the position sizing, there are multiple factors that we look at. I mean, internally from a portfolio perspective, we have guardrails in terms of the sector level overweight and underweight, the number of stocks, the liquidity parameter, and obviously the non-benchmark exposures and so on. So the multiple factors which we kind of run on a daily basis to kind of see that we are within the guardrails. The position sizing would clearly depend on the size of the opportunity, the conviction that we have, and the competitive advantage that the company has. I mean, stronger the competitive advantage, the more the position sizing. Again, higher the liquidity, larger the name in a particular sector, the exposure can be much higher. For example, a bank where the liquidity is very good and the bank's growth or prospects are very high from a next 5-10 year perspective, we could have a lot more exposure. It will also be driven by, to some extent, what is the benchmark weight for those sector and those stocks. Like I said, from a guardrail perspective, we have overweight and underweight limits. So to that extent, we have to be benchmark aware, if not kind of following the benchmark, at least we have to be reasonably aware of the benchmark. So these are some of the various factors that we look at while kind of deciding the position. And needless to say, eventually the valuations, I mean, if it is in a very attractive zone, we would have far higher weights there. But as and when the stock continues to perform, maybe we'll kind of trim the position to reduce the active weights or the overweight if the valuations have moved up. In terms of changes that we've done in the last year or so, we've slowly been increasing our exposure to IT. Maybe we've done that a little earlier than probably when the businesses have started to turn. But nonetheless, I mean, that is one thing where we believed that compared to 2021, at the start of 2023, the valuations had already moved down because of the price correction as well as time correction. The earnings had moved forward, but the stocks had actually stayed there or even come down. So to that extent, the excesses in valuations were taken out, and that's where we started to increase the IT exposure. We've continued to have the overweight on IT for most of the last year. Besides that, we've had some exposure to some public sector entities on the energy side and utility side, where we believe the valuations were quite attractive and the volume growth or the business growth was visible. And to that extent, we did have some exposure to those names and some incremental addition to metals as well. While broader construct, we still remain underweight on utilities, metals, and many of these cyclical sectors. But from a bottom up perspective, we did find some opportunities and we've taken exposures.
Sure. Thanks a lot, Karthik, for that. There are a few questions coming on the sectors. So before I take that one question to you, Vetri, so given that our strategy like FlexiCap, which follows quality growth strategy, has seen relative underperformance compared to the value set of funds which have been doing well in the last 2 to 3 years. So what is the strategy that we have adopted, and how do you think investors or distributors can look at this style rotation that keep happening in the market? So if you can share some highlights on the recent last 2 years performance of the style-based indices or the fund performance.
Sure. So as you rightly pointed out, Niranjan, the last 2.5 years have been very strong for value. In a way, this is a reversal of the cycle that was there in the previous 2 to 3 years, where quality growth actually had a very strong cycle. When you look at the alpha, keep in mind that that alpha is an outcome of how favorable the tailwinds are at that point of time for a particular strategy, which is coming from the way that the market itself is sort of behaving or rewarding companies for their performance. So, I think we need to keep that backdrop in mind, that what looks like the current underperformance or outperformance may just be reflected to the way the market is currently driving a particular or favoring a particular style. Two additional points to make. I think today the outlook for quality growth is vastly improved. From a tactical point of view, the outperformance of value towards growth has now gone on for a very long time relative to past trends that we have seen. So we are somewhere ripe for a trend reversal. That's the pattern we can learn from history. The second point that I would make is that from the peak of interest rates, we are likely to see some decline. So the peak is behind us. How much rates can come down, we will have to see. But certainly, I think we can take some comfort that the baseline at this point is that the peak of rates is behind us. In a way, that would be slightly better for quality growth, because remember, these are companies where you are looking at their growth prospects over a very long period of time. Higher the rate, the less the discounted cash flow value of the company, and therefore it negatively impacts the PE multiple. Now, if you have some visibility that peak rates are behind us, it becomes more supportive from a valuation perspective. The other point that I would make in terms of valuation, because that is again very, very important, there has been some derating which has happened of the kind of companies that tend to dominate quality growth. These are high return on equity businesses. They generate free cash flow, very stable margin. What we are seeing now in the market is an unusual scenario where many businesses which are more cyclical, they tend to be more volatile in terms of their ROEs. They tend to be more project-led, so their cycles are more acute. These businesses are starting to see valuations which are starting to catch up with more stable state, long runway growth businesses. So you look at some of the companies which are in more project related businesses, engineering businesses, they tend to have more cash flow related challenges. These companies are now starting to get valuations on aggregate which are very comparable to some of the highly valued companies in the consumption space. So now that you have this parity in valuations, I would also say that the base case being that you have increased valuations in this segment of the market, the needle starts to move towards neutral, if not in favor of quality growth, because those companies definitely have far superior matrices. I think from our point, we continue to review the portfolio in FlexiCap. We have made several changes. Those of you who track our commentary would have seen some of the changes that we made in the portfolio. But there is no reason for us to shake up the portfolio unless the companies themselves are doing very, very poorly. And when we look at the company performance in FlexiCap, it has continued to remain fairly good in terms of growth metrics, ROE metrics, etc. It is stock price which has not done so well, but I would submit that is actually now gradually moving valuations in our favor. But wherever companies are not meeting our expectations, of course, we will continue to sell those companies. And even within our set of companies which are high quality, we do use valuation spikes to sell those businesses and reinvest in our existing portfolio in companies which are valued cheaper. So that is a very active process which continues at all points of time.
Yeah, sure. Thanks a lot, Vetri, for that. Karthik, now we will move on to take the questions on sectors. So the first one is the pharma sector, right? So the domestic India market is likely to grow at a steady 9-10% growth in the pharma industry, right? So, however, there seems to be some pressure on the export-focused players in terms of their sustainability of margin. And also, the domestic player also very well placed today, right? So how do you see this playing out in the medium to long term? So, and also, how do you, the fund point of view, allocate into various segments of businesses in the sector?
Right. Niranjan, domestic pharma, like you highlighted, probably it is growing in line with nominal GDP. Probably we could have that 8 to 10% kind of growth, and clearly with increasing health insurance penetration and awareness and increasing per capita income, we could see clearly focus on health, and this space could continue to do well. The domestic business is akin to FMCG in many cases because many of them are branded businesses making healthy margins and ROCs and don't need much of capital. To that extent, they are probably comparable with FMCG. Obviously, they may not be as strong as FMCG in terms of the branding aspect, but nonetheless, they're closer there. Coming to the exports business, US is the large market, and what we've seen in the last 8-10 years is continuous price erosions, high single digit kind of price erosions, which of late seems to be kind of coming down. So to that extent, if at all, the last 6 months or a year, the price erosion impact may have come down a little. And also, some of the domestic companies are focusing a lot more on complex generics, where the pricing impact is not so significant. So from a UTI large cap fund perspective, what we look at is companies which either have very strong domestic focus or companies which have a lot more focus on specialty or complex generics, where the pricing erosion is far lower. But overall, like you said, I mean, the sector looks good from the valuations perspective. They're still not very expensive. They've done well in the last year or so, but still not very expensive because this is one sector which is kind of significantly underperformed, even from a stock market perspective in the last 8-10 years. Post that, we've seen some kind of a catch up. Also, in UTI large cap, we do have some exposure to diagnostics. Like I said, I mean, as the country kind of grows, we'll see a lot more opportunities on the hospitals and diagnostics or the entire healthcare infrastructure. So we'll have some opportunities on that side as well. So we have some exposure to diagnostics as well.
All right, yeah. Thanks, Karthik. So the next question is on the consumers. Right. So while there is an expectation of gradual recovery in the disposable incomes in the rural India, companies with exposure to the urban wealthy continues to see strong growth across the categories. Right. So do you expect this divergent trend to continue? And also, what are the pockets which you think are exciting you today?
Right. So if I take the question for FMCG, so what has happened even in the recent past is the urban segment seems to have done better than rural. Maybe, I mean, monsoons, inflation, post-COVID recovery, there has been some amount of dichotomy. And we've seen the urban recovery being a little better than rural, as even Vetri highlighted, most of the consumer companies also are commenting on those lines. Eventually, I mean, with probably if next year monsoons are good, we see that the rural pockets also kind of recover. But overall, the way to look at it is the per capita income could continue to increase. But what we are witnessing, the premiumization trend is something which is far more strong and likely to continue from a longer term perspective. There are still opportunities on the penetration side for FMCG or staples, but the premiumization trend can last longer as the per capita income grows and people move on from aspirers to middle income to higher middle income and so on. So to that extent, a lot more opportunities could be there on the premiumization, while in the pure staples, there is some amount of penetration peaking out, and to that extent, in some categories at least, it is peaking out. And that's where we're seeing FMCG companies, and even in the last 5-10 years, the growth has been single digit. They're highly profitable companies, but considering the growth being in single digit and the valuations already have moved up in the last 5-10 years, the risk reward is still not favorable.
All right. Thanks, Karthik. So, Vetri, there is a question on inflation. So, although the global inflation environment has been on a steady decline, so the inflation in US is still somewhat above its target of 2%, right? So, the inflation currently is still around 3.9%. So, while Fed expects 3 rate cuts in the current calendar year, so do you expect the rate cycle cut cycle to begin, may say, immediately, or would it take more time?
So, prior to the latest sort of readings we got from the US economy, all of which were extremely robust, the market was actually discounting that there could be a rate cut in March itself. But now the market no longer expects a rate cut in March. They have moved the probability of a rate cut, I think, to May. So I think the base case would remain that the US will be able to cut. Because remember, even at 3.5 or 3.9% inflation, while it's above their target, the repo is actually sitting, I mean, their policy rate is actually sitting at 5.5. So by their own history, that's a reasonably large spread that they have. So I think, 2 to 3 rate cuts, 3 rate cuts is what the Fed chairman talked about. That should be the base case. I think the 140 basis point rate cut, which is closer to 6 rate cuts that market is expecting, seems a little excessive.
Sure. Thanks, Vetri. So, in the interest of time, we will take maybe last 2 or 3 questions. So, again, Karthik, this is a question to you. So, the PSU banks have seen a significant run-up ahead of the MPC's expectation of dovish policy, which is to see the face of the rate cut, right? So, however, the banks are likely to be hurt by continued contraction in the net interest margins, right? So how do you see this playing out for especially the PSU banks?
Right. So PSU banks, the biggest advantage is they have very strong liability franchises. Many of them have built it over many decades and very strong reach in nooks and corners of the country. So that's their biggest advantage. Post-COVID, their balance sheets have been cleaned up, and to that extent, the asset quality issues or the credit costs have come down significantly. And that has helped these banks to kind of report very good numbers. Most of them have come to 1% kind of ROA and good teens plus kind of ROEs. And on the back of this, we've seen re-rating. Many of them were trading in sub book or sub one-time price to book. Now they've come to close to one-time price to book or even higher in some cases. In terms of NIMs, probably they've not gained too much on the way up, and again on the way down, maybe they'll not get impacted too much. The volatility of NIMs with the interest rate is not so much in India as much as in the other economies, and to that extent, they may not be impacted too much on the NIM side. Right now, like I said, the credit costs are far lower than the longer term average, and that has helped them report good ROAs. We'll have to see how the credit environment kind of moves in the next 2-3 years. And if the credit costs remain low, they can continue to report good numbers. That will be the key determinant more than the NIMs. And from a growth perspective, the private banks from 0% market share have been steadily gaining market share in the last 25 odd years, while the PSUs have been kind of giving away share. So we'll have to see the PSU banks' growth compared to the industry. So the banks which are able to kind of maintain their market share may be at a better position compared to the ones which are slowly or gradually kind of losing out.
Sure, Karthik. So there is one question on the IT also. So if you can just help us understand. So there seems to be some continued pressure on IT companies because of cuts in revenue projection or some uncertainty there, right? So what is your prognosis on the sector's growth outlook? Yeah.
From a longer term perspective, again, IT companies have been able to grow well. They've been continuously gaining market share. Again, these are export stories, US being the large market and Europe next. And many of them have the Fortune 500 clients as their top clients. So if at all there is some amount of slowdown there that is reflected here. But overall, from a longer term perspective, if we look at 5 years or 10 years, they've continued to grow well. This is a sector which is tracked very closely, and that's where even a few percentage miss is kind of highlighted a lot. But from a longer term perspective, they've been able to grow probably around high single digit on dollar terms and probably double digits on rupee terms. And that can still continue because most of the clients are moving to the cloud, and the digital transformation journey is still on. So we see good visibility from a longer term perspective. But near term often is guided by the sentiments in the US economy and the European economy, and if at all there is some amount of slowdown or cuts on IT spends, that gets reflected here. What we clearly see is longer term they've created a lot of wealth, and in the last few years they've been returning that wealth in terms of buybacks and dividends, and they don't require much capital. The high ROC businesses, very good on corporate governance. So to that extent, the story remains quite intact and steady. We could have 1 odd year or few quarters volatility here and there, time and again. But if we take a longer term picture, it looks good. Like I said, I mean, probably 2 years back, the valuations were quite high. They had moved up compared to their own history. But a lot of that has got corrected because of absolute price correction and time correction.
Sure. Thanks, Karthik. So one last question to Vetri. So Vetri, so the government's decision to stick to the path of fiscal consolidation, despite being a election year, broadly is positive from the capital market point of view, right? So, however, from the investor point of view, is it a right time to rebalance their equity portfolios to align with the potential opportunities, be it at the market cap or the sector or the investment style? So if you can throw some insights there.
Sure. We talked about risks earlier, Niranjan, and we talked about the weight of expectations. I think one of the intelligent ways to manage the risk is really to sort of look at where are your financial goals. To get to those financial goals, what was the asset allocation pathway that you had determined for yourself? And then look at how the current portfolio might have moved away from that targeted allocation. One, because of the strong outperformance of equities, your equity allocation may be higher than targeted. Secondly, within that, your allocation, particularly to the mid cap and small cap, may have gone up very significantly. And therefore, there is an opportunity to correct that as well. So, this is not a binary thing. Nobody, I think, should really take a call in terms of saying, reduce all equities and go 100% to debt, or reduce all small and mid cap and only go to large cap. I think in most investing, it is not a binary decision. It is only a question of acting at the margin to sort of rebalance in line with what the long-term objective is. So I would say one of the best ways to manage your risk at this point of time, rebalance. That's the best way to do it.
Great. Yeah. Thanks a lot, Vetri. I think that is a wrap for today. So thanks, Karthik Raj, as well. So thanks to all the participants for sharing your questions. So if we are unable to could not take any of your questions, probably you can actually get in touch with your relationship. So we'll be more than happy to answer them. Alternatively, we can write to us at askUTI@uti.co.in. So we'll be more than happy to revert back. Just a request to the participants, please use the feedback link available on the screen to share your feedback on the topics that we covered today, and also the webinar in general. It always helps us in terms of doing better work in the upcoming engagements with you. And with that, hope to see you again in the next webinar in the month of March. And thanks a lot, everyone.
Thank you. Thank you, everybody. Have a good day.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.